Good morning traders, listen to this number. 0.7193. Right now, the Australian dollar is melting up across every single time frame. Monthly, weekly, daily, 4-hour, 1-hour, all screaming strong buy. But here's the trap that nobody is talking about. The minimum wage just got lifted by 4.75% as inflation reaccelerates, and the herd is piling in exactly at the resistance that has capped this pair for weeks. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. You need to see the one level that separates a melt-up breakout from a brutal stop run. I am not going to let you be the exit liquidity that we are in a trending session, and the bias is unapologetically long. But every trend has a trapdoor. Write this number down. 0.7136. If the 4-hour candle closes below 0.7136 today, the entire structure resets. That is the floor the bulls cannot afford to lose. And here's what makes this moment dangerous. Retail sentiment is showing nearly 70% of traders are already long, which means the positioning is crowded. Yet institutional flow data over the last 24 hours shows something different. They're not fading this. They're using every minor dip to add to longs, not short. When the herd leans one way and smart money leans the same way, you either get a vertical melt-up or a savage engineered stop hunt before the real move. The 0.7136 level is your invalidation line. Everything I am about to show you hangs on that number. Close below it on the 4-hour, and I want you to flip defensive and consider the range trade between 0.7107 and 0.7136. Until then, the path of least resistance is higher. Now let me walk you through the charts from the top down, because this is where most traders get it wrong. They look at one time frame and miss the symphony. Pull up your weekly chart. The 200-week moving average is not even visible because price is soaring so far above it, but the 50-week moving average sits right around 0.7135. That is exactly why 0.7136 is your support on the daily. The market is treating that 50-week MA as institutional backing. On the daily, the 200-day moving average is sloping higher at 0.6878, and price has not even sniffed it in weeks. The 50-day is at 0.7135, almost identical to the weekly number, and the 20-day is at 0.7170. Look at the order. Price is above the 20-day, which is above the 50-day, which is above the 200-day. That is textbook bullish alignment. On the 4-hour, the moving averages are stacked like launchpad steps. The 20 period is at 0.7170, the 60 period is slightly below, and the 200 period is acting as a trend anchor miles lower. The 4H MACD is printing a slim positive value of 0.002, no negative divergence whatsoever. The RSI sits at 52.43. Not overbought, not even close. That means momentum has room to accelerate. If this turns into a momentum chase, RSI can run to 70 before we even get a warning flicker. Here's what most traders miss. The monthly, weekly, daily, 4-hour, and 1-hour all reading strong buy simultaneously is an anomaly. It creates a false sense of safety because when everybody sees the same bullish picture, the market often does the most painful thing possible first. It runs the stops. The resistance cluster at 0.7193 is the perfect stage for that. Just above it, we have 0.7221 and 0.7250. But if you step back and look at the volume profile, 0.7193 aligns with a high volume node where price got rejected 3 times in the last 10 days. That makes it a liquidity magnet. The trap is that breakout traders will buy the first push above 0.7193, and the stop run from sellers defending that level could easily flush price back to the 20-day moving average at 0.7170 before the real continuation. So the hidden opportunity is not buying the initial poke above 0.7193, it is buying the successful retest of the breakout, or entering on a confirmed 4H close above that zone with the 0.7136 floor intact. Support levels below are clean, 0.7136 first, then 0.7107, and the deeper backup at 0.7079. On the resistance side, if 0.7193 breaks cleanly, 0.7221 becomes the first magnet, then 0.7250. And I want you to watch gold while you trade this. Gold is moving tick for tick with real yields collapsing, and that risk on pulse in commodities is feeding straight into the Aussie dollar because of its China proxy personality. Iron ore futures bounced 3% in the Asian session. And copper just reclaimed a critical moving average. When the China trade is hot, AUD is hot. This cross-linkage is your hidden confirmation. If you see iron ore taking another leg up, it will pour jet fuel on the AUD breakout. Now let's connect the fundamental driver, because the minimum wage news changed everything. Yesterday, the Fair Work Commission lifted Australia's minimum wage by 4.75%. Inflation had been cooling, but now it is re-accelerating. That one decision slams the door on any near-term RBA pause narrative. The rates market is repricing viciously. A 50 basis point hike in July moved from a 10% probability to 40% practically overnight. When you combine that with a US dollar that is struggling to hold its own because Fed rhetoric is turning subtly less hawkish, the rate differential widens in the Aussie's favour. The 2-year yield spread between Australian bonds and US Treasuries just ripped to the highest level in 3 weeks. That is rocket fuel for the currency. And here is the kicker. The RBA minutes next week could easily confirm that internal debate has shifted toward front-loading hikes, which would push 0.7250 onto the map faster than most expect. The 1 to 2 week directional lean is clearly higher, targeting 0.7250, but only if we hold above 0.7079 on a daily closing basis. The event that invalidates this entire bullish thesis is a US CPI print on Thursday that comes in hot, above 3.6% core, triggering a dollar-vicious rip. But right now, the market is not pricing that. It is pricing an Aussie wage spiral. So I ask you directly, do you think the dollar breaks 105 this week? Comment yes or no. I'm tracking consensus across the channel. Your answer reveals whether you fade or ride this AUD move. Most people skip this section. That's exactly where the money is made. Keep watching. I'm about to lay out 3 trade setups, each with precise triggers, invalidation levels, and exact risk-reward numbers. And after each setup, I want you to drop your stop loss or your range in the comments. Let's see who is actually building a plan. The first setup is the sniper, the conservative play for traders who want confirmation and structure. Here it is. Wait for a 1-hour candle to close above 0.7193. That is your trigger. Do not chase the spike. Let the market pull back to 0.7190, which should act as support once broken. Enter long on that pullback with your stop loss at 0.7170. The logic for that stop is clean. Below the 20-day moving average, below the 4-hour 20-period MA, and below the round number that acts as a pivot. Your first target is 0.7221, the next resistance cluster, and your second target is 0.7250. That gives you a risk-reward of 1 to 2.6, and if you let the second target run, it becomes closer to 1 to 3.5. What voids this setup entirely? A 4-hour close back below 0.7170. If you see that, the breakout is false, and you exit without hesitation. Drop your stop. Loss for this sniper entry in the comments right now. I want to see if you're aligned with the 0.7170 level. The sniper, conservative, entry, 0.7190, after 1-hour close above 0.7193 and pullback, stop loss, 0.7170 take profit 1, 0.7221 take profit 2, 0.7250 risk, reward, 1:2.6R to TP1, 1:3.6R to TP2, invalidation. Void if 4H candle closes below 0.7170. The second strategy is the active trader, the standard plan for people who want to play the trend without chasing breakouts. The entry condition is a retest of the 4-hour 20-period moving average, that 0.7170 magnet, but only if it holds. You wait for a 4-hour bullish rejection candle, a wick below and a strong body closing back above 0.7175. Enter long at 0.7175. Your stop loss goes below the swing low, which is exactly 0.7136. So place it at 0.7130, giving room beneath that structural support. Target 1 is the exact 0.7193 resistance, and target 2 is 0.7221. Once target 1 is hit, move your stop to break even. That trailing rule protects you from a sudden reversal while allowing you to capture the breakout extension. Risk-reward on this setup is approximately 1 to 1.9 for the first target, but with a free ride to the second target it expands to 1 to 3. This setup voids if a 4-hour candle closes below 0.7136. That is the line in the sand. Type your Australian dollar to US dollar range for tomorrow in the comments now. Let's see who's aligned. I want the high and the low you expect. Your range tells me whether you're thinking like a sniper or gambling on noise. The active trader, standard, entry, 0.7175, on bullish 4H candle bounce off 0.7170, stop loss, 0.7130 take profit 1, 0.7193 take profit 2, 0.7221 risk, reward, 1:1.9R, to TP1, 1:3R, to TP2. Trailing stop, move SL to break even after TP1 hidden validation. For H candle close below 0.7136. Now the third setup is the aggressor. This is high risk, counter-trend scalping for traders who can lose small and think fast. The idea is to fade the first violent poke into 0.7193 on a 15-minute time frame, because institutional stop runs often create a fake-out spike before the real move. Entry is a limit sell at 0.7190, targeting a quick mean reversion back to the 20-period moving average on the lower time frame. Your stop loss is terrifyingly tight, 0.7195, just 5 pips above the entry, because if the level breaks with conviction, you want out immediately. Target 1 is 0.7170, and target 2 is 0.7160, aiming for a risk-reward of 1 to 4 on the scalp. But understand this warning clearly. The overall trend is strong buy on every higher time frame, so you are betting against a freight train for a quick scalp. If the 15-minute candle closes above 0.7193, you exit instantly, no questions. Only take this trade if you have active screen time and are willing to accept a small, fast loss. This is not a set-and-forget play. The aggressor, high risk, entry, 0.7190, limit sell, stop loss, 0.7195 take profit 1, 0.7170 take profit 2, 0.7160 risk, reward, 1:4R, scalp, invalidation. 15-minute candle close above 0.7193, exit immediately. Risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news, especially not US CPI or RBA minutes. Stops are non-negotiable. This is how you survive to trade the next big move. Now here is the summary you take into tomorrow. The single most critical level is 0.7193. A decisive 4-hour close above it opens 0.7221 and 0.7250. Fail to break, and we retest the 0.7170 to 0.7136 support band. The invalidation that resets everything is 0.7136 on a 4-hour close. Tomorrow's wildcard is the RBA shadow and iron ore's next leg. If China industrial profit surprise, the Aussie could gap through resistance before the London fix. I'm covering the full breakdown on Bitcoin and the S&P divergence in the next video. That video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.